So welcome to week 13, everybody. This is chapter 11 on bonds payable, and we're going over bonds specifically compared to other notes payable and long-term debt because bonds have a lot of really specific math related to them. And it's also really important. It's a huge space in finance, and it's also consumes most of my workday at the accounting firm that I work for. So this is a topic that I am particularly excited about, and it is the math that informs my work every single day. So bonds, they're very important. The bond market is huge. It's way bigger than the public stock market, the bond market, the fixed income market, and big banks trading private loans and private credit. That's getting a lot bigger as well. And the valuations are all math-based, and as opposed to equity valuations being a lot more subjective. Like how much is a stock worth? How much is a bond worth? Bonds are generally more stable and they pay interest. And there's a lot of math that goes into the valuation based on the duration of the bond, the maturity date of the bond, the interest rate of the market currently, and how much interest the bond pays, and then also the principal payment at the end, the credit worthiness of the company, and some other factors. And we won't be focusing so much on the valuation today as we'll be focusing on the accounting. But the accounting it is influenced by the valuation that the market determines on the bonds. And there's a lot of career and finance opportunities because trading in the fixed income markets is a lot determined by like work that financial analysts do that goes into trading the bonds. And also that's at an investment fund, equities maybe aren't traded so much, but if there's short-term bonds, those mature every 3 months or so, or even commercial paper matures every night. And so there's a lot of operational work to do in the bond space too. And it's so huge. This is how companies raise money to fund their operations, whether or not they're public companies. I mean, if they're public companies, they can issue public bonds, but private companies issue debt as well. So going over, I guess, just some details about bonds. They have some specific standardized characteristics to make the math a little easier, and also to make looking at a bond, most bonds are structured the same. So a bond is a financial debt instrument that says the borrower repay a stated amount referred to as the principal or face amount at a specified maturity date. So there's all these terms. And so we have the maturity date, the face amount, that's the amount on the face of the bond back when bonds had actual physical bond certificates. The giant amount on the face of the bond, that's how much you would get for turning in your piece of paper at the maturity date. And then they also have a certain amount of interest, and the interest is called either the stated interest or the coupon. And that's because when there were bond certificates, there would be coupons at the bottom, and you would clip off a little portion of the coupon and turn it in every 6 months and get the interest for that period. And interest is paid on bonds twice a year or on designated dates. Again, this for standard corporate bonds, the face amount, and this maybe not for standard corporate bonds, the face amount is always $1,000. Interest is always paid every 6 months. And again, there are always exceptions. And in this course, we'll be going over an entire bond issuance. So for example, a company issues $66,000 worth of bonds. Then we would do the accounting for $66,000. But the increment of the bond and what people can actually trade on the bond markets is $1,000 face value amounts. That doesn't mean it sells for $1,000 though, because there may be reasons where it goes up or down based on whether or not the market thinks the interest rate on the coupon, which is set, right? The coupons are created at the beginning of the bond. Thinking back to when there were physical bond certificates, the coupons are written down at the beginning of the life of the bond. Those don't change. The same semi-annual payment gets paid every 6 months to the bondholders. But the market, interest rates change. I don't know if you guys have seen the news lately. There's always talk of the Fed raising and lowering rates. That's because it influences bond valuations so much and equity valuations so much based on the discount rate that's applied when valuing the bonds. Because let's say that a company issues bonds and they're trading at their 5%. If the Fed increases rates to 6%, everybody's going to want to buy the new 6% bonds because they're going to get more interest on the new 6% bonds. So that means that the old 5% bonds sell at a discount. They sell for less because the bond traders do the math and make it so that they're purchasing at a discount so that the total return over the life of the bond is at the new 6% rate because rates have gone up. That's generally the concept of bond valuations. And there's a bunch of different kinds of bonds and different terms that determine like characteristics of the bond. So a secured bond is backed by collateral. Unsecured is not backed by collateral. In secured and unsecured, there's also what's called priority. So certain bonds get certain priority in bankruptcy. And that actually, I have a family member that works in like bankruptcy for and restructuring for bonds. And it is always a huge deal with the lawyers of who gets the money first, what banks get the money first. So that's really important in the how risky is the bond, because if it's the top priority, if it's secured by collateral, that means that the bondholder is not going to lose the principal amount. Bonds really, it is focused on preservation of capital and then getting the interest that they are promised on the bond. And then the term of the bond. So a term bond matures on a single date, and that's most bonds. Most bonds, if we go back to the previous slide here, they have a face amount. The face amount is paid at the end, and interest is only the interest that's on the coupon is paid every 6 months. However, there are serial bonds, which means that it matures in installments, and that can be however they specify on the bond. They could say, okay, the bond is going to pay coupons of this every 6 months, and then maybe at 3 years it's going to pay back 500, and then at 6 years it's going to pay back 500 of the $1,000 bond. So serial bond means that it matures in installments, and that can be defined however they want. But a callable bond means that the borrower can pay off the bonds early. And banks don't like this. I mean, so think of this as a mortgage. A mortgage, every residential mortgage is, in the state of Minnesota, are required to be callable. That means that you can pay back your mortgage early. A lot of corporate bonds are actually not allowed to be paid back early because that makes the valuations a lot simpler. Because if a interest rate on a bond is 5%, and for 10 years, a investor would like to buy that bond and guarantee that they're going to make 5% over the next 10 years. Because if interest rates fall to 1% and the borrower could just call the bond, pay the bonds back, and refinance at 1% interest rate. That's something that I think a lot of people take for granted when they have a mortgage, that you can pay it back early and refinance, or pay off the mortgage early to reduce debt because that's a secure lifestyle. That's not always a right when it comes to bonds. So a callable bond means it can be paid off early, and sometimes the callable price on a bond can be more or less than the face amount. There are always plenty of terms and conditions to look at. And then a convertible bond means that the lender can convert the bonds into common stock. And this is generally used for really risky bonds, startup companies, where a lender can preserve their capital by owning a bond. So if the company isn't doing very well, they're still going to collect their interest. They still can collect their the face amount of the bond in bankruptcy court before equity shareholders for sure. But if the company does really well, blows up into a huge startup, they can convert the bonds into common stock. It says on the bond agreement how many shares they get for how many bonds, and then the company no longer owes the bond back, and then they have shares in the company. And so it can be a really good way for companies to raise money if they're more risky of an investment and provide some more security to more upside potential to the investors. And also, if you want a complex bond market, work in the convertible bond market. It adds such another level of complexity and research that there's a lot of opportunity in the convertible bond market for institutional investors to make a lot of money. So now we'll go into the objectives now. We're going to talk about what are bonds, what are the terms and conditions that can apply to bonds, and then how do we account for bonds, issuing the bonds, paying the coupons, amortizing the premiums and discounts, and then paying it back at the end, the face amount, and then describe how the times interest earned ratio is used to evaluate a company's financial condition. Basically, how much is the company making compared to how much interest do they owe? And that's a very common metric by bond investors and banks to determine, can the company afford the interest that they're already owe, and should we lend them more money so that they can pay our new interest? And then determine the selling price of a bond using present value concepts, and describe and illustrate the effective interest rate of amortizing bond discounts and premiums. And so this is more on the valuation side, and we'll get to that at the end after we go through a lot of the initial concepts. And so once again, the problems in this chapter are quite simple in the sense that there's less boxes to fill out in the homework, but more complicated in the sense that it's math. But we'll go over the math together, and I'll definitely will be posting a video about it, and we'll go over all the math, and you guys should be able to get through without issue. And so a bond is an interest-bearing note, and it requires periodic interest payments with the face amount repaid at the maturity date. And the creditors or bondholders of the company have claims on the company's assets that rank ahead of common stockholders. So in the order of bankruptcy, the top priority is collateral. Because if a loan is collateralized, for example, a car loan, a mortgage, a equipment loan, if a company goes bankrupt or if a person goes bankrupt, the creditor can seize the asset. And generally they'll go in before bankruptcy even is fully in swing and just take the assets. Then goes the other creditors, which is like actual debts. Think employees, wages, the IRS, other bondholders, unsecured bondholders. There's no assets backing it other than the general assets left over by the company during a bankruptcy. Equity, and then it's preferred equity, and then common equity is last. And so it goes risk highest or risk lowest first in bankruptcy, risk highest is last in bankruptcy, but the equity has the upside potential. They get all the profits of the business. And so that's the risk reward consideration when investing in bonds or investing in equity, is the equity has all the upside potential and the bonds have all the downside protections. And they differ in face amount, interest rate, interim payment dates, and maturity dates. You know, most bonds are paid every 6 months, but mortgage-backed securities are paid every month because mortgages are paid every month. And it can depend on the cash flows that come from the underlying bond. And then they also differ in other ways, such as if the company assets are pledged in support of the bonds too. I mean, companies can actually pledge they are allowed, if they properly disclose, to pledge the same collateral to multiple different loans. And then there's also disclosed how many people have interest in this collateral, How much of it can they get? There's all these terms, right? And that all goes into determining how risky is the bond, because how risky is the bond determines what's the interest rate that's actually associated with the bond. So the face amount is the principal. It needs to be repaid on the maturity date. The contract behind the bond is called the bond indenture, and that explains all of these terms and conditions. And the two most common types of bonds are term bonds and serial bonds. And when all the bonds mature at the same time, they're called term bonds. If the bonds mature over several dates, they're called serial bonds. And so that um, think of installment versus pay at the end, notes payable. And there are also a variety of more complicated structures, such as convertible bonds and callable bonds, as we talked about earlier. And all of this goes into the credit rating of the bond. So right now, this is the yield curve for all bonds in the US bond markets right now. And I just found this on Fidelity's website. As you can see, short-term treasuries carry the smallest interest rate other than municipal bonds. These are state and local governments can issue municipal bonds, and then the interest is tax-free. So that's why those are at a lower interest rate, because the effective profit after-tax profit of these is comparable to the other bonds. And so bonds also have a credit rating. Think of that's similar to a credit score, but for public companies. The top credit rating is AAA, and then you have AA, single A, triple B, and then below triple B, you have double B, single B, and then C's, and then D, and then basically after D is in default. They're active securities actively in bankruptcy, and they're still traded. People still trade because people need to get their money out at some point, and they're not, certain institutions are not allowed to hold bonds that are in bankruptcy, and so there's always trading around. And the reasons companies and investors do like to invest in bonds as opposed to notes payable or bank loans is bonds are traded on the public bond market and are much more liquid. You can get your money out in between the issue date and the maturity date. An investor could sell the bond to another investor if they need the cash for some reason. And so interest rates go up for different maturities of bonds. For example, triple B, which is the lowest, I believe the lowest investment grade bond, is 4.32% compared to 3.85% for the short term. And then, long term, the triple B gets all the way up to 6.8%. And then there's also the certificate of deposit rates too that are lower. And then that's how banks make money, is on the spread between giving money to bank customers at 3.9%, lending it out at 4.3%, and then taking the interest. It's tight, bit of a tight spread, but anyways, that just gives you guys some context for the decisions that we're going to look at today. And so when a company issues bonds, the proceeds received for the bonds depend on the face amount of the bond, the interest rate on the bond, and the market interest rate for similar bonds. And so just because a company is a AAA bond doesn't mean they're going to get exactly 3.80% on their bond. They could be a high AAA or a low AAA. It kind of just depends on what investors are doing. And the bond rates change every single day based on what people think the Fed is going to do and what people think the economy is going to do. And so there's no way to perfectly estimate the interest rate that they should be paying on the bond. And so they hire some investment bankers and they decide on what's called a coupon rate or a contract rate. In the homework, it's going to be called contract rate. In the real world, everybody calls it coupon rate. So that's just so you know. um, or original issue interest rate or something like that. And the market rate of interest or the effective rate of interest, that's what we were looking at Fidelity's website. That's what are the people actually paying for bonds of that credit quality and duration. And duration, I I say duration in a loose sense. Duration can mean the distance till maturity, and it can also mean how sensitive is a bond to interest rates. And since we're dealing with very simple bonds, it's it's effectively the same. Um, but if you want to look into a lot of calculus-based math, look up how to calculate convexity and duration on bonds, just for your own knowledge. And you'll figure out how sensitive is a bond's price to interest rate swings. So the if the market rate is greater than the contract rate, the bonds will sell for less than their face value. And that's really important. If the coupon rate is in this case, if the coupon rate is 2% on a bond and the market rate is 3.8%, everybody is going to adjust the price of the bonds so that every investor for every type of bond for the same credit quality, the same duration, if everything is exactly the same, they're entitled to the same market percent to price the bond. So they will adjust the price of the bond. If the coupon is only 2%, they're going to reduce the price of the bond until the math works out that over the life of the bond, they're going to make 3.8%. So if the coupon rate is 2%, it would sell for less. If the coupon rate was 6%, then the bond would actually sell for more so that the return would reduce to 3.8%. And a bond sells, the price of the bond goes up or down to make sure that everybody's making the same return despite what the actual coupon or interest payments are going to be made on the bond. And if the market rate is less than the contract rate, again, okay, let's see. So, and I would maybe just write these examples down. So if the market rate is more than the contract rate, then the bond is sold at a discount. If they're equal, it will sell at the face amount. Because if the market rate is exactly 5%, it's going to pay 5% for its whole life, then it's already equal. So it'll sell for the face. And then if the market rate is less than the contract rate, then the bond is going to sell at a premium because they shouldn't. And the reason this happens is because markets are generally pretty efficient. If there's a free lunch out there, people are going to bid on it and reduce or increase the price to wherever is going to get them the equal return to whatever the market's providing. Because the bond market's huge. There's so many other options. If the bond is not selling at a discount, no one's going to buy it. Everybody's going to buy all the other bonds that are selling at a discount. And if the bond is selling, you know, it's going to even out to the proper price, essentially. Does anyone have any questions about, I guess, characteristics of bonds before we go on here? Okay. So the face amount of the bond that must be paid on the date the bond matures is called the what? Principal, exactly. So also called the face value. And so if a bond is issued at a discount, the market rate was greater, so an 8% market rate, right, with a 7% coupon. And if it's at a face amount, it's equal. And then if the market interest rate is less, the bond is going to sell at a premium. And a lot of times when companies will issue bonds, they'll hire an investment banker or an investment banking firm, and they will come up with what they think the interest rate should be, what they think the terms are going to be that's going to get the company the best deal on their debt. And then they will call up a whole bunch of investors and tell them that they should buy the bond at this particular rate. And then they'll guarantee that if it doesn't sell, the investment bank will often buy up the remaining bonds because they've done the research and they're pretty sure that it's worth that amount of money. And then they'll charge a bunch of fees. And bonds may be issued at their face amount, a discount, or a premium. And when the amount is different than the face amount, we have to amortize that discount or premium over the life of the bonds. And in an accounting journal entry sense, we need to do this because the cash received is different than the bond payable amount. And so we need to have another account called discount or premium and amortize that difference over the life of the bond. And as you can see, it's not a perfectly straight line curve because interest is exponential in nature and as opposed to linear. And so for a bond issued at a premium, the carrying value decreases over time because bonds issued at a premium have a higher coupon rate than the market rate. So the interest being paid every 6 months is greater than the effective interest rate on the bond. And so they're paying back a portion of the bond that was originally issued. As opposed to a discount, that means that the interest rate was on the stated interest rate or the coupon rate was less than. The interest keeps on accruing because they're not paying back. If the effective interest rate was 6%, the coupon rate is 5%. They're effectively paying less than the market interest every month, and so the carrying value of the debt will slowly increase over time. Carrying value is the carrying value is the face value plus the premium or minus the discount. And so we'll go through some examples of the math, and in these examples, the amounts are given to us. So, and there are bonds that are so more complicated bond terminology for you guys. Bonds are generally traded in $1,000 increments, but the price of the bond are often priced as a percentage of par. Par being the face value or the maturity value. So price of 100 just means that at face value. That's all that means. So priced as a percentage of par or face or maturity value, that's what that means. So price of 100 doesn't mean that they're at a 90% discount to 1,000. It means that they're priced exactly at par. And the contract rate of interest is 12%, the term is 5 years, and the market rate is 12%, which is why it's priced at 100. And so the journal entry then is quite simple. We debit cash because we as the company receive cash, and then we credit bonds payable. And that's the bonds payable amount is always going to be the face amount of the bonds that are issued. And then every 6 months, we take 100,000 times 12% times half a year, and we get $6,000 paid on 100,000 every 6 months. Per $1,000 bond would be $60. And then at the final year, after 5 years, we pay back the principal by debiting bonds payable and crediting cash to pay back the principal at the maturity date. And so this is up to this point, this is all fairly similar to the notes payable chapter. And now we're going to go over an example of a bond sold at a discount. So does it say the price? Doesn't say the price. So the face amount is 100,000. The contract rate of interest is 12%, but the market rate is 13%. So we have to discount the bond so that the investor's total return over the next 5 years is going to be 13%. And that's what's used for that is a present value formula that we'll get to in the appendixes. And so they tell us exactly how much the bonds sell for. And as accountants, we don't actually have to value the bonds. The market values the bonds and says the bonds sold for 96,406. And so that's the cash that we receive. And so we debit cash, and then we also have to debit discount on bonds payable because the bonds payable credit is going to be 100,000 in every example. The face value or the maturity value is always going to be what goes in bonds payable. The difference, whether it's a discount would be if it's a debit and the premium would be a credit. It's a contra account to the bond payable. And that's what arrives at the total of these two is the carrying value of the bond. And then the carrying amount of the bonds payable, again, it's bonds payable minus discount on bonds payable or plus premium on bonds payable. And it's also, you can know that too because it's debits or credits. An easy way to remember is it is a discount if the cash is less than bonds payable. It's a premium if the cash is more than bonds payable. And then the debit or credit, our debits and credits always have to equal. So you can know whether it's a debit or credit for sure based on, do I need more debits or credits in this equation? And then the interest expense is amortized every period over the bond. And so the amortization effectively increases the contract rate of interest on a bond to the market rate of interest that existed on the date that the bonds were issued. We don't adjust it every time the bond markets change every day. They issued it and the market rate was 13%. And so we need to calculate interest expense at 13% of the carrying value of the bond. And then we need to, the interest expense is the interest expense that we calculate based on the market rate of interest. The cash amount is the cash coupons that are paid every 6 months. And then the discount on bonds payable is slowly reduced every time because the interest expense is greater than the cash that was actually paid. And that's what generally increases the carrying value of the bond because we're crediting discount on bonds payable. So the credits in a liability contra account will increase liabilities because the liability is slowly growing over time because our interest expense is greater than the cash coupons. And then at the end of the period, all of the math works out so that the final payment exactly reduces the discount to 0 and the face amount is paid back at 100,000. And there's 2 methods to computing the amortization of a bond discount. So make sure it will specify in the homework what method is being used to amortize the interest. Straight line amortization is much simpler. We essentially divide the divide the discount over the amount of coupons that are on the bond or the amount of payments. And these are 6 months increments, by the way. They're not, so in this case, the term of the bond is 5 years. We don't divide it by 5, we divide it by 10 because they pay interest every 6 months. So every 6 months we have a journal entry and it reduces it by the 6 month straight line amortization. The effective interest rate method, which is required by GAAP, is, we'll discuss that in the appendix when we get into the math behind the valuations. That uses the interest formulas. Basically, we take the interest rate, the effective interest rate at issue, or the original issue interest, and then we multiply that by the carrying value of the bond. And because of the present value math, it amortizes it in the nonlinear exponential rate because that's how interest is calculated when we are interest is an exponential function, right? So using the effective interest method, the interest expense is not going to be the same every single period. Under the straight line method, it will be a straight linear line. We get this much bond amortization every 6 months. And so in this case here, the semi-annual amortization is $359.40. That also means our interest expense every single period is going to be the same as well. And so the interest expense is going to be the coupon paid plus the discount on bonds payable. That's our interest expense for the period. And that really just makes our debits equal our credits. And so I highly recommend writing out these T accounts. It makes it so much easier to keep straight in your head. When I do these problems, I write out T accounts for myself because it keeps straight. Is a discount a premium? Is a discount or a premium a debit or a credit? Is reducing or increasing a discount or a premium a debit or a credit? If the journal entries, if you're writing out the journal entries as you go, if you're writing out the T accounts as you go, balancing every journal entry and the cash and the face value and the coupons paid, everything else will take care of itself based on debits equal credits. So in the straight line method, we calculate upfront. This is going to be our interest this is going to be our amortization every 6 months. And then we include that in our journal entry as a debit or a credit, depending on whether it's a discount or a premium. Again, this is going to be a credit because the discount was a debit when we created it, and we're reducing the discount to 0 over the life of the bond. And the effect of the discount amortization is to increase the interest expense on every semi-annual payment. And this increases the contract rate of interest to the market rate of interest at the issue date. You can think of the games that companies would play if they could issue bonds at 2% when rates are actually 4% and only record 2% interest on their financial statements. In order to accurately reflect the interest that these companies are charged based on their credit rating, based on the duration of the bond, and everything else, we have to use discounts and premiums to accurately reflect how much interest these companies are paying. And then as the discount is amortized, the carrying value of the bond increases until it equals the face amount of the bond at the maturity date. It would also be a matching principle thing. If we go back to our this is such a good graph. If we had the interest, if we didn't amortize our discount, the face value of the bond would remain at the discounted value, and then it would all be paid back at the end. And we need to spread out our interest expense over all the periods under the matching principle. We need to record that interest when it was actually incurred, not at the end of the loan when it's actually paid back. And now we'll go over an example of bonds issued at a premium. So this is the market rate of interest for this original issue is 11%. Same exact bond, 5 years. And so what we're going to do is, the bonds sell for 103,759. So we know our cash has to be debited for 103,000, and then we credit bonds payable for 100,000 because that's the face amount. We're always going to credit bonds payable for the face amount, and then our debits and credits don't equal, so we need a premium of $3,769. And that increases the carrying value of the bond to the 103,000 because it was issued at a premium because the coupons are greater than the market rate. And so amortizing a premium, because we're paying more cash than interest effectively is, our interest expense is actually going to be lower than the cash that was paid. And we're going to amortize it in the same straight line way or effective interest rate way as the discount. And so we're going to have interest expense, premium on bonds payable as our debits, and then cash as our credit. And because premium on bonds payable amortization is a debit, that reduces our expense because we don't need as much interest expense to balance out the cash that was paid. And then slowly over time, because we're debiting our premium account, we are reducing the carrying value of the bond over time. And so to calculate our premium under the straight line, premium amortization under the straight line method, we divide the total premium divided by the total amount of coupons in the bond, which is 5 years times 2 is 10 periods of coupons, 3,769 total premium, and then $376 every period. And so every 6 months, we're going to have to record a journal entry, interest expense of 5,623. That's the plug in this situation. 6,000, we know what our cash is. We know what our premium amortization is. The interest rate is simply a plug from there. And it effectively decreases the interest expense over the period of the bond. And that's because the market determined that this company deserves a lower rate of interest. And they're paying less interest over the life of the bond because they got more money for the bond issuance. They got over 100,000 for issuing the bond. And at the end of the period, they're only paying back 100,000. So it's like, where did that 3,000 come from? It came from the cash payments. Every single period, they're effectively overpaying their interest. So it has the same, and under the effective interest method, it decreases the principal over time and it would decrease the effective interest rate over time, having a similar effect to making early payments on a mortgage or something like that. There's less interest expense over time. Whereas a discount, the interest expense increases because they didn't get as much money for the bond and they still owe the 100,000 at the end. So I know, so the effect of the premium amortization is to decrease the interest expense. And then as the premium is amortized, the carrying value of the bond slowly decreases to the face amount at the maturity date. And so a company may redeem or call bonds as they mature. Normally, the call price is above the face value. Most common I've seen is a call price of about like 102, which means that 2% the um, above the face value. Because a lot of these prices are priced as a percentage of par. So what's the call? The call price is also as a percentage of par. So 102 would mean that maybe 2% above the face value would be the call price. And a company, generally, if there's a call provision in the bond, the premium that a company receives is never going to be more than the call price. Because can you imagine if this company had a call provision at 102 and then they issue it for $103,000 and then the next day they call it at 102? Like they would literally just get $1,000 of or 1% of the issuance as free money out of the deal. Then of course, they wouldn't have raised their money, but they would get a 1% of just free money. And so, depending on whether investors think that a company will call the bonds, and again, if a company has billions of dollars in bonds and no cash to pay them back, companies will purchase bonds above the face value depending on how much interest rates have fluctuated. But that's a really important valuation metric that can be hard to put a price on because it's a it's it's not an exponential math equation like interest, and it's not a linear one like time. It's a binary one. It either is above or it's not above the call price, and they have to figure out how to value that. And the techniques are very similar to derivatives valuation of options because it's essentially a call option on the bond. The company at any time, no matter what the market price is, if the market price is 104, the company can buy the bond at 102 at any time. And so it's valued in the same way as an option. And a lot of times companies like that's how an investor would value it too, is they would basically take the amount of the bond with no call option on the bond, and then they would value the call option, add it together, and that would be the new valuation of the bond. And they can also redeem the bonds by purchasing them on the open market. And that's effectively how refinancing is done on corporate bonds for the most part. I think call options, they're common enough, but I think most companies, when they retire debt, they purchase the debt back on the open market. Sometimes for more, sometimes for less, based on if interest rates have changed or if the company's credit rating has changed since initial issuance. If a company was initially like a single B credit rating, which is essentially a junk credit rating, or if they're like triple C credit rating, then eventually they increase to triple A. The rates that we saw in Fidelity, right? The rate is less the higher the credit rating. And so a company, if their prospects have changed, they no longer need the money, their credit rating is better, they might be able to purchase the bonds back at a discount and actually make money, so to speak, by buying back their own debt, which is really interesting. And so we'll go over the journal entries on bond redemptions now. And so this is for redeeming the bond before maturity date. That's what these journal entries are for. Because if we're redeeming the bond at maturity date, there's not going to be any premium or discount left to amortize. Our math on amortizing the bond's premium or the bond discount is in a way that at the end, when the bond matures as normally scheduled, there's nothing left, and we just pay back the bonds payable at the face amount. However, when we're calling it, like for example, if they could call it at 102, we have to actually record that as other revenue because that would be a gain. So in this example, there's a company, they have bonds payable at of 25,000. Uh, and well, okay, they have a face amount of 100,000. The premium remaining on the bond at the time of this journal entry is $4,000. They decide that they're going to call, oh, they're going to purchase them on the open market. So they're trading them on the open market for a discount, which means um, rates have increased, right? I don't actually know. Again, it's really hard to think about conceptually sometimes, which is why the math is so important to. So essentially, they're able to redeem these bonds on the market. They buy their own debt back for $24,000. It's only a quarter of the debt, so the face value is the bonds payable of 25,000. The premium on bonds payable is 1,000, and the gain on redemption in bonds is what balances the journal entry, and that's $2,000 because they purchased 25,000 in face value and $1,000 in premium. So they had issued this previously or whatever for 26,000. They purchased it back for 24,000. They need to record $2,000 in gain when they purchase these bonds back. Um, And this would generally mean that actually rates have gone up. If rates go up or the credit of the company goes down, which means their interest rate would go up, then the price of the bonds would fall uh, because the coupon payments no longer adequately compensate the risk on its own. So there needs to be a discount. So they issued it at a premium, then now it's at a discount. So they're purchasing it back, and we have to record the gain. And then, assuming that the company calls the remaining 75,000, which are held by a private investor for 79,500. Um, so that again, this would be their call price that was specified in their contract. And then the bonds payable is 75,000. The premium is $3,000, and then the cash paid was 79,000. To balance it out, we need 1,500 in loss. And I'm sorry that it's that the slide is so small here. And then um, so if the and really it's all based on the carrying amount. If the carrying value of the bond is greater than the cash that we pay, it's a gain because we're reducing liabilities more than the cash that we're giving away. And if the opposite is true too, if we're paying 79,000 in cash to get out of this debt, but we only have it on our books at 78,000. Remember the 75,000 plus the 3,000 in premium. That's the carrying value. We paid 79,500. So there's 1,500 in loss that we have to record, but we don't owe any interest anymore for the rest of the period. And this was a hefty interest bond. Um, I guess the previous example was, this is a new one, but so Bellwether interest, Bellwether Industries issues $1 million in 10-year bonds with a coupon of 9%. The market rate is 11%. So will the bond sell at a premium, discount, or par? I heard discount. Why would it be a discount? Exactly. So the market rate is higher than the bond rate. And so then to compensate for that, the bonds will be discounted below par value when they're sold. So now we'll go through a few examples of the entries for issuing bonds. So uh, Thomson Company distributes semiconductors. They issued 1.2 million of 10-year 8% bonds. at face value, interest payable May 1st, November 1st, and um, the fiscal year of the company is a calendar year end. So record the journal entries on the following dates. So May 1st, we issue the bond at par. So we debit cash 1.2 million, credit bonds payable 1.2 million. Then we make our first interest payment, which is 8% times 6 out of 12 months of 1.2 million is 48,000. And then on December 31st, we have to make an adjusting entry similar to all of our notes payable adjusting entries to record the interest that's been accrued over the last 2 months, but not going to be paid until May 1st of the following year. And so we take 1.2 million times 8% and then divided by 2 months. And we'll do the same for a bond issued at a discount. So in this issue, we had a $15 million bond issue, 5 years at 6%, and the market rate of interest is 7%. So Chin received cash of 14,376,000 because the market rate was greater, so they had to sell the bonds for less, so that the investors are getting 7% over the life of the bond. The company's paying 7% over the life of the bond. And so to issue the bond, initially, we record our cash and our bonds payable. So we debit cash for the amount of cash that was received, credit bonds payable, and then the discount on bonds payable is the difference. And the discount is always going to be a debit when it's initially created because it takes the place of cash that would have been in the debit spot. And then every period under the straight line method, we're going to amortize that discount. So for example, I'll show you guys how this is calculated here. We take 623,000 divided by 10 installments because there's a coupon every 6 months. And we have to amortize 62,374.5, round to the nearest dollar. And our discount on bonds payable amortization every single period is 62,375. And because creating the discount was a debit, reducing the discount is a credit. And so we credit our cash, which is the 6% coupon times 15 million divided by 2 because it's every 6 months. And then we have to add those two together to arrive at our interest expense, which is going to be the same every period. And since we know that this is the interest expense every 6 months to is this? It's sort of annoying that they don't say the dates. Do they say the dates? I don't actually see that on here. Anyways, it's implying that this is aligning with the calendar year. So the annual interest paid is 15 million times 6%, and then the discount amortized is 62,375 plus 62,375 is 124,000. the interest expense for the first full year after this bond is issued, whether it's a calendar year or whether it's a fiscal year, 1 year from the date of the bond being issued, this 1,000,000 24,000 is going to be the expense. If there's a mid-year and we're calculating how much interest is it for fiscal year end, under the straight line method, we just take our interest expense for the first full year, which is going to be the same every single year under the straight line method, divide it by 12. That's our monthly interest, and then we multiply for the amount of months we need for our adjusting journal entry. And again, the bonds sold for less than their face amount because the market rate of interest is greater. The interest expense of the company is more than the cash they're paying every single time. So the amount of the initial carrying value of the debt, if we imagine, I guess, issuing this on the bond market, and the company, they can buy back their own debt at any time on the bond market, assuming someone's willing to sell it to them. If they issued this for 14,376,000, they could theoretically buy it back for 14,376,000 a day later, probably. I don't know why they would do that. It might be a few dollars more, but that's how much they're in debt on the first day of the bond being issued. Their debt load is slowly increasing over the life of the debt as we're crediting the carrying value of the bond. And then the bond is selling for less. The market sets the interest rate. Their market rate was 7%, and so that's going to be their interest expense over the life of the bond, computed as a percentage of their initial carrying value and their initial market interest rate. And so amortizing a premium, again, we have a similar method. We have a $20 million bond, 5 years, 9% market. 9%, so it's a 9% bond at a market or effective interest rate of 8%. So we receive cash of 20,811,000. Interest is payable semi-annually, April 1st and October 1st. The initial issue of the bond, we know our cash debit, 20,811,000. We know our bonds payable is going to be the 20 million face amount, and so we need an additional credit for the premium on the bonds payable because effectively the company raised 20,811,000. That's how much debt is going to show up on their balance sheet because that's the amount of liability. If they had to buy the bonds back on the market, that's how much it would theoretically take, assuming that there's enough liquidity for them to do that. Then the interest expense, we need to take the premium of bonds payable of 811,000 and divide it by 10 semi-annual payments on the bond. And then we get 81,101 is our 6 months. That's every 6 months, that's our discount that gets amortized. And then our interest expenses, the premium decreases our interest expense because we pay our cash of 900,000 to create the premium was a credit, to reduce the premium is a debit. And therefore, there's less debits left for our interest expense. Our interest expense lowers. And so determine the amount of interest expense for the first year. Oh. I don't know why that went away. But we can compute it fairly simply ourselves. So again, the bond issued 818,000 is our interest rate that's our interest expense every 6 months. Under the straight line method, it's going to be the same every period, 818,899 divided by 6. Our interest expense every month is 136,000. And they issue the bond on April 1st. That means they have 9 months in interest in the first year. So our interest expense in the first year would be 1,228,000. And then for the first 12 months of interest, and then every 12 months afterwards, our interest expense is 1,637,000 every 12 months. And the adjusting entry, even if there's um, the adjusting entry at the end is going to be interest expense, and then it's getting into the math here, whether it would be interest payable or bond. If you would separate interest payable, tech, my opinion, my personal opinion is that the interest payable would be the portion of the cash over the next period, because a payable is actually cash that's going to be paid in the next 6 months. And then the premium or discount would also be adjusted at the end. I could also see it as the to make it simpler, taking the what the initial so there's the initial creation of the bond, October 1st, there's the interest, and then we have 3 months in interest. What I'm trying to talk about, I know I'm not making sense right now. If we our end of the year journal entry 12/31. So we issued the bond April 1st, October 1st, we have to pay this interest. We have 3 months left. The full month of October, November, December left on this bond for this year. Our interest expense for those 3 months that we have to record at the end of the year is 409,449. That's going to be the same no matter what. So we'll have debit interest expense. The credit is either going to be interest payable, the credit would just be interest payable. That's simple. Because there's a premium on the bond, I think the credit would just be interest payable. It's my firm opinion at this moment. Does anybody have questions about the bonds stuff so far? Bond valuations. It's so exciting. It's such a huge bond market out there. There's so much money to be made. This would be considered, I mean, even $20 million bond issuance would be considered a fairly small bond issuance. And this is probably a good stopping point. This next example will take longer than 3 minutes. So thank you everybody for attending today.